Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates, and 10-year note yields continue to hold a very tight range. Going back to late last week, we've held a range of about 314 to 319 over the last several sessions. Really not seeing any scare of a move back towards the highs that we just recently hit up or towards 3.25, or back towards the old highs, which are now the level looking to breach below, and that's 312. So we've kind of been just staggering here in between, with data sort of tug-of-warring at the market. Likewise with global tensions on red alert via trade policies. There continues to be a lot of uncertainty, and the market is very unreactive. It's waiting for something to push it one way or the other. Right now there's pretty good odds that it could go either way, and the market is waiting. So right now we're waiting for that moment, that what could happen next moment. And market volatility remains elevated, which is a surprise because in Treasury space, we haven't seen elevated volatility for quite some time. Yes, it's back below the 14-day moving average. Yes, it's off those extreme highs we saw last week, but it certainly remains elevated versus where it's been. Over the last, call it 7 or 8 years, we've had volatility swings all over the map, except the last 2 years. 2017 and 2018 have not been very kind years to those buying volatility, as we've just remained stagnant and had not seen any sort of spikes or any kind of sustained move, which would tell that the market is caught off bounds or caught off balance or caught in some way looking the wrong direction. So right now, market volatility remains low on a historical basis, but we're elevated to where we've been over the last 2 years. I think that's important because the market hasn't seen that in quite some time, which means another move may be coming. Which direction, we don't know yet, but right now it certainly is coming. And lastly, let's look at those minutes we got today. One of the drivers or key focus points of today's trade. Yeah, we got some housing numbers this morning that weren't real pleasing, but we thought that the hawkish minutes would take care of that. And ultimately, the minutes didn't tell us anything we didn't already know. The Fed mentioned, yes, trade policies could be disruptive to the economy. Yes, they talked about the strong dollar possibly being disruptive to policy. But in the big picture, the Fed wants to stay the course. They want to continue to raise rates until we get to a normal policy level. They would risk running rates a little high as opposed to keeping them a little low like they have over the last, call it 10 years. I think the big dilemma here for the Fed is that if you look at Fed fund futures pricing, they are well below where the Fed wants to be going out to 2019 and 2020 and even over a longer term. So right now, the market and the Fed are not seeing things eye to eye. The market wants some kind of proof or is looking for some kind of puzzle piece that the Fed doesn't have. The Fed wants to do what the Fed wants to do, and it will. And the Fed will be in charge of raising rates, but will they catch up to the market, or will the market catch up to the Fed, is the big question. And right now, 10-year note yields hovering at that 315 level, not giving us any clue here. No signs yet. If we see a back trade below 312, I think that means the market is giving up on any type of aggressive move by the Fed. If we go back towards 3.25, it means that the supply and the economy are probably going to be the next real dictators of policy, and that's probably a good thing at this point, because lower yields at this point suggest that the economy can't back up what the Fed is hoping that it will. This is Todd Colvin coming to you from the floor of the CME Group.